Welcome to Money Matters. I'm Emily Johnson, Certified Financial Planner and Managing Director of Polaris Capital Advisors. I'm joined today by David Kroll of Mortgage Network. Thank you for joining us today, as usual. And we wanted to discuss today just some general themes that we're seeing in the market and what that means for your overall financial plan. So this is sort of, we're seeing, I don't want to say it's ho-hum right now, but you do kind of get that, and I hate to say this, calm before the storm type feeling. In all markets, equity markets, bond markets, commodities markets, although those are moving a little bit more. But really, it's very calm at the moment. We're seeing little ticks up. And I know, you had sort of, before the show, you had sort of referred to that as a bubble. Where are you seeing that?
What I'm seeing is a nervous tension in the market. It's certainly in our bond market, what dictates our interest rates. We've been at a very, very, very low rate for
a very long time.
For a very long time. So we know it has to go up. And the smartest people in our company who do the trading on Wall Street say that when it goes up, it's going to go up 200 or 300 basis points all at once.
Really? That's because so
correct.
You're not hearing the tapering effect that David Tepper was talking about, the hedge fund manager?
No.
Really? That's
No.
interesting.
What they're saying is that when Mr. Bernanke stops pouring money, the Federal Reserve stops pouring money into the bond market and the mortgage market, it'll be like the air out of the balloon.
Now, is that largely because it's actually the Treasury that's buying the debt, and because our debt level is going to catapult so much with just small increases in interest rates that it's going to feed on itself, and therefore, or I guess the question is, what is the motivator that you see for interest rates jumping, 300 to 400 basis points at a clip?
Well, basically, the unassisted interest rate, without the Fed in the market, is somewhere around 5.5%.
How do you assume that? And you're assuming that's a 10-year that you're looking at?
That's the 10-year is at 1.
Two and, yeah.
Two,
it hit 2
2
today.
It hit
yeah.
2 today.
Yeah.
And it was
So to
at
your point, it could move fast.
1.75 earlier in the week. And in 1 week, it's moved up 25 basis points, which is 1/4%. We were at 3.5. We're now at 3 3/4 for the 30-year mortgage. When Mr. Bernanke came on television today, we lost another full 1/4%. By the time I get back to the office from this session, I expect us to be close to 4%. So that's a 0.5% move.
But the argument has actually been that there will be a gradual, that the Fed is going to have control over the tapering or the reduction, of, I guess, the participation in, keeping this artificially low. Do you feel that is truly going to be out of Bernanke's hands, that the markets are going to dictate?
So. We think the markets will dictate. Yeah.
Interesting.
Because he told us what he's going to do.
So you think that the mass exodus theory is actually the one, there's going to be money that's just flooded out of bonds quickly?
That's what we believe.
And where does it go?
That's the problem.
Right.
Which takes us back to your ho-hum,
yeah.
or nervous tension ho-hum, which is, for a very long time, we haven't known where to put the money. And the stock market seems to be at a reasonable high at the moment. What do you think? I mean, can money safely pour into the stock market at this point?
Well, I guess, I don't want to answer a question with a question, so we're still sort of relatively one of the stronger nations, despite, reductions in credit ratings, et cetera. We're still one of the stronger areas to be. Interestingly, you are seeing a lot more strength in European debt. Where we used to have 30% yields on things, we're actually seeing now more like 8% yields. This was in Greece, where it was 35% yields in Greece. Now it's about 8%, which of course means the prices on those bonds have gone through the roof. So there was a lot of smart money, I think, that moved into the Greeces, the Spains, the Portugals. Whether it stays there or not, I don't know, but it's possible, I guess, that you could see it move over there and see those rates come down if there's perceived relative strength.
Correct.
Over there.
Correct.
But I agree with you when it comes to the equity markets. I think that most of the assumption is that we might have artificial valuations based on these artificially low interest rates that are being used to value stock prices.
One of the odd things is that most of the wealth in our society right now is concentrated in 50 to 65-year-olds. That's where almost all the money is. What I see is those people coming back strongly into the real estate side of the market, but making very conservative decisions.
The new normal that we've discussed before, not getting the $1 million beach house or the, but more getting the, the third row at, 650.
That's correct, or even less, or even less, the condo at 350. Perfectly happy. So that's a new normal, a new conservatism amongst the people who have all the money. You're seeing it, because you were saying just before we came on air, that folks are coming in and saying, well, I want you absolutely no risk, zero risk portfolio.
Right. I want a zero risk portfolio with an 8% return.
Yes,
and not dipping into principal.
Right,
And and people have been saying that for ages and ages, but the stomach for risk right now is zero. Especially among that age group. Those that are going to be retiring soon or already retired. It's zero. And it's interesting because they're happy, and I don't want to stereotype, but I'd say that by and large, many of my clients that have money for retirement saved, they're actually much happier accepting a lower rate of return with that lower risk, whereas the conversations that I had with folks 6-7 years ago was absolutely I can stomach the 26% decline in a bear market, or a 35% decline in a bear market, as long as you're telling me that I'm going to get on average 12% a year.
Yes, right.
So we actually start conversations now, like we were talking about before the show. We start conversations now, and this might sound negative, but with a look at if you had your current portfolio right now, and you went back to 2007 and experienced 2007 through 2009 with your current portfolio, what kind of a loss would you expect to receive? And that's where we start, because that's eye-opening for a lot of folks. But you couple that with the fact that if you actually have what is perceived to be a conservative portfolio of, say, short and intermediate term bonds, there's actually a lot more inherent risk there, and especially with what you're saying of the expectation that interest rates could go up 300 to 400%, that would demolish the conservative portfolio.
That's correct.
So it's really turning things on its head, in a lot of the financial planning meetings that we have now, because these assumptions are different.
It's very tricky. All of the conversations begin with, what's your plan? What are your expectations? What are you trying to accomplish? How long do you think you're going to live and be healthy? Where do you want to end up? Do you want to end up in your retirement home in Hilton Head, or back with the grandchildren in Ohio? Those conversations are really as important, if not more important, than what technically I do.
Absolutely.
Because at
the end of the day, that's what people are going to do.
That's correct.
And so helping to prepare them for that when they get there, as opposed to just saying, oh, well, I guess I'm going to decide I'm going to do this. Now I have all these assets and liabilities. What do I do?
That's correct.
So, yeah.
That's correct. Because if we get the plan right, what the person is going to do, what you're going to do with your life, if we get that right, if we listen closely, then we can much better use the tools to make some semblance of that happen.
Right.
We may not get an 8% yield on the portfolio. I may not get you a 3% fixed rate mortgage, but I will get you what works for your plan.
Right.
That's the point. If I never ask the plan question, then I'm dealing in the abstract. Well, just get me the lowest possible rate. That's pretty much meaningless.
That's a good point. I don't want to skip back around to this, but I thought that your comment before about the big jump in rates was really interesting, especially since that sort of goes against what we're hearing a lot, from a lot of the hedge fund managers and analysts. So I like hearing that from your side, because that's really what you focus on all the time. Why would an increase in the 10-year stop at 300 to 400 basis points? What's to say that it actually wouldn't just keep going? I mean, what kind of a ceiling do you put on something like that if it's actually going to be costing the U.S. government more money to finance itself?
I think that's the right
scary
point.
Question.
That's the scary question. I think the fact that the United States is what's the expression that's used? The tallest midget.
I knew you were going to say that. I was waiting.
The United States is the tallest midget in the room. In other words, everybody has problems with their economies, every nation has problems with its debt.
But many of them are addressing theirs, and other than the sequester, we're really not.
Correct, but
Yet.
we're still perceived as the default currency, and we're still perceived as the safe haven. So as long as we're perceived as the safe haven, our debt can, the cost of our debt can balloon up 100 basis points, 200 basis points to, if Treasury is 2% right now, then maybe 4%.
Right, so we're looking
but
at
some
relative
point,
measures.
there's a ceiling because all the money from around the world flocks here, and then pushes it back down again. And if it gets too high, then the government will step in and
Start printing again.
stop printing again.
Right.
Yeah.
A vicious cycle that we've gotten ourselves into.
Because it needs cheap debt.
Right. And the timing of the whole thing is, I mean, nobody has their, little, little, whatever those little black balls are that you can shake and
Right,
get.
right,
We don't,
right.
we don't have that, but the timing is really the question that, and I think
that's
that's why you're saying that the market is so nervous right now, because you're starting to see that inch and you're wondering if it's going to take
Is
a
this
mile.
is this the one?
Right, is this
Yes,
when we
is
start
this-
rolling?
Right, that's exactly it. We all kind of know that rates have to go up, and they have to go up a good slug. We just don't know when.
Well, let's bring that. Let's bring that back actually around into some other markets and some other planning components here in just a second. We will take a short break, and we'll be right back. This is Money Matters. Please stick with us.